The six major types of taxes in the United States are personal income tax, payroll tax on wage and salary income, corporate income tax, estate and gift taxes, tariffs, and property taxes. This table shows the shares of the different tax types on the tax revenues of the federal government. From the table, nearly 85% of all federal government tax revenues are personal income and payroll taxes. Personal income tax is a tax on all forms of income that an individual or household receives. Taxable income is a household's income minus exemptions and deductions. Exemptions are the dollar amount that can be subtracted from taxable income based on the number of persons in the household. Deductions are other items, such as interest on mortgages, charitable donations, and moving expenses that can be subtracted from taxable income. A tax bracket is a range of taxable income that is taxed at the same rate. Here shows the 2013 United States federal income tax brackets of the taxable income and the marginal tax rates corresponding to the tax bracket. Marginal tax rate is the change in total tax divided by the change in income. The average tax rate is the total tax paid divided by the total taxable income. There are three different types of marginal tax rate taxes: progressive tax, regressive tax, and a proportional tax. A progressive tax is a tax for which the amount of an individual's taxes rises as a proportion of income as the person's income increases. Regressive tax is a tax for which the amount of an individual's taxes falls as a proportion of income as a person's income increases. A sales tax is generally regressive. A tax system can also be regressive if the people with higher incomes are afforded larger and larger deductions. And last, a proportional tax. A proportional tax is a tax for which the amount of an individual's taxes as a percentage of income is constant as a person's income rises. This figure illustrates the actual marginal tax rates for the United States taken from an Internal Revenue Service tax schedule. Since the marginal tax rate is increasing, the tax system is progressive, unless the richer people are afforded a larger and larger deduction. A flat tax occurs when the marginal tax rate is a constant number. An example of a flat tax is Steve Forbes' 17% flat tax plan in 1996 and 2000. Some of the Eastern Bloc countries like Estonia, Latvia, and Russia have had flat taxes. Estonia at 24%, Latvia at 25%, and Russia at 13%. The Netherlands has been considering a 40% flat tax. When Steve Forbes ran for president in 1996, his campaign centered on a flat tax of 17%. Here's how it worked. 1. A flat 17% marginal tax rate. 2. No tax for the first $36,000 of income. And 3. Taxes applied to only the wages. No tax on personal savings, pensions, or etc. A payroll tax is a tax on wages and salaries of individuals. Payroll taxes go to programs such as Social Security, Medicare, and unemployment insurance. Corporate income tax is a tax on the accounting profits, not economic profits, of corporations. Currently, the corporate income tax range anywhere from 15 to 35%. An excise tax is a tax paid on the value of goods at the time of purchase. A sales tax is a type of excise tax that applies to total expenditures on a broad group of goods and services. A property tax is a tax on the value of property owned. We know previously that a tax on a good shifts the supply curve to the right. We also learned that a tax on a good drives a wedge between the price that buyers and sellers pay. The change in the price that buyers and sellers pay determines the tax incidence. Tax incidence is the allocation of the burden of the tax between the buyer and the seller. The buyer's share of the tax is the difference between the old equilibrium price and the new equilibrium price after the tax. The seller's share of the tax is the difference between the old equilibrium price and the price that sellers receive net of taxes. This figure shows the effect of a specific tax on the market equilibrium with elastic and inelastic demand curves. Note that the deadweight loss resulting from the tax is smaller when the demand curves and the supply curves are inelastic. From the figure, the buyer's share and the seller's share of the tax varies with the elasticity of the demand and the supply curve. In particular, notice that when the demand curve is inelastic, or when the supply is very elastic, the buyer's share of the tax is high. An example, the difference between the old and new equilibrium price is large. The top left graph and the bottom right graph illustrate the scenario. Similarly, when the demand curve is elastic or when the supply is inelastic, the seller's share of the tax is high. The top left graph and the bottom right graph illustrates this scenario. The effects of a tax on labor income can easily be analyzed using a labor supply and labor demand curve, as illustrated here. A personal income tax shifts the labor supply curve to the left, with the vertical distance between the old and new labor supply curves depending on the value of the tax. As the labor supply shifts up, the equilibrium quantity decreases and the equilibrium wage rises. The reduced work will cause a deadweight loss. Just like with the tax on a commodity, the size of the deadweight loss depends on the elasticity of the demand and supply curve. Since part of the payroll tax is paid by the employer and part by the employee, then we need to analyze both effects. This figure illustrates the effect of a payroll tax if the employer pays for the tax and if the employee pays for the tax. If the payroll tax is shared by both employer and employee, then the effect is the combination of both graphs. If the payroll tax is paid by the employer, then an increase in the tax is an increase in cost of hiring a worker and results in a decrease in the demand for workers. This is shown in the graph on the left side. If the payroll tax is paid by the employee, then an increase in the tax is an increase in cost of working and results in a decrease in the supply of workers. This is shown in the graph on the right. An increase in personal income and payroll taxes will result in a decrease in the quantity of hours worked. This is important for the government to know. If the government's objective is to maximize government tax revenue. This figure shows that higher tax rates do not always lead to higher tax revenues. This is also known as the Laffer curve. A higher tax rate may increase the tax revenues if the increase in revenue brought about by the higher tax rate outweighs the decline in revenue brought about by the decrease in working hours. This is usually true at lower tax rates. A higher tax rate may decrease the tax revenues if the increase in revenue brought about by the higher tax rate is smaller than the decline in revenue brought about by the decrease in working hours. This is usually true at higher tax rates. Transfer payments is a grant of funds from the government to an individual. The grant can be in cash or in kind and does not require repayment. Means-tested transfer is a transfer of payments that depend on the income of the recipient. Social insurance transfer is a transfer payment such as Social Security that does not depend on the income of the recipient. Social Security is the system through which individuals make payments to the government when they work and receive payments from the government when they retire or become disabled. Medicare is a government health insurance for the elderly. Unemployment insurance is a program that makes payment to people who lose their jobs. These social insurance programs are not means tested, as wealthy individuals can also receive these benefits. Current Population Survey is a monthly survey of a sample of United States households done by the United States Census Bureau. It measures employment, unemployment, the labor force, and other characteristics of the United States population. To summarize income data, we rank the population according to income and divide the population into fifths, or what we call quintiles. Quintiles is a division or groupings of 1/5 of a population ordered by income, wealth, or some other statistic. This table shows the range of annual family incomes for the quintiles for the United States in 2004. The table illustrates the distribution of family income by quintile. From the table, the top 20% of the population earn 47.6% of total income, while the lower 20% earn only 4.2% of total income. We can construct a measure for income equality using our data for income distribution in the previous figures. Specifically, we can construct the Lorenz curve and the Gini coefficient. Both measures for income inequality can be used to compare inequality across nations or inequality within a nation through time. A Lorenz curve is a curve showing the relation between the cumulative percentage of the population and the proportion of total income earned by each cumulative percentage. This figure illustrates a sample Lorenz curve. If income is perfectly distributed, then the cumulative proportion of the population equals the cumulative proportion of income earned by the population. If income is perfectly distributed, then the Lorenz curve should be a 45-degree line from the origin. On the other extreme, if income is perfectly unequal, then only one person earns all income, and the rest of the population earns nothing. In this scenario, the Lorenz curve should be an inverted L-shaped line. Most economies have a Lorenz curve between the two extreme income distributions. The shaded area between the 45-degree line and the Lorenz curve is a measure of inequality. This area depicts the deviation from perfect equality and is used to measure the Gini coefficient. Gini coefficient is an index of income inequality ranging between 0, perfect equality, and 1 for absolute inequality. It is defined as the ratio of the area between the Lorenz curve and the perfect equality line to the area between the lines of perfect equality and perfect inequality. The larger the Gini coefficient, the more unequal the distribution of income. The smaller the Gini coefficient, the more equal the distribution of income. This figure compares the income distribution of the United States, Brazil, Bangladesh, and the world. Two facts are of interest. Fact number 1, there is great income inequality in the world. Fact number 2, the income distribution in the United States is worse than that of Bangladesh. Poverty rate is the percentage of people living below the poverty line. The poverty line is an estimate of the minimum amount of annual income required for a family to avoid severe hardship. The poverty line is based on data that families spend 1/3 of the incomes on food. It is calculated as 3 times the Department of Agriculture's estimate of the amount of money needed to purchase low-cost, nutritionally adequate amount of food, adjusted for the size of the family. This table shows the poverty line for several family sizes in the year 2004 in the United States.